Inventory valuation is the cost of unsold inventory at the end of a reporting period. It is based on the costs required by the entity to buy the inventory, transform it into a saleable state, and deliver it to the appropriate location for sale. Since inventory is sometimes the most valuable asset a firm possesses, it is critical to routinely monitor its value. Understanding your inventory valuation helps you increase profitability and maintain your company's financial records accurate and up to date. Consequently, it aids in the creation of a clear picture of your company's financial status and profitability. Costing your inventory may appear difficult at first, but by selecting a system and mastering it, you'll be well on your way to maintaining more accurate record. However, before coming up with the appropriate valuation, it is necessary to comprehend first what inventory we have in order to better value inventory. Inventories are assets held for sale in the course of business, in the process of production for such sale in the form of materials or supplies to be consumed in the production process or in the rendering of services. Measurement. According to the framework, inventories shall be measured at the lower of cost and net realizable value, also known as LCNRV. Net realizable value is the estimated selling price in the ordinary course of business, less the estimated cost to sell and cost of completion. On the other hand, costs are those that are incurred in acquiring the inventories, producing them, or rendering a service depending on the nature of the business. To better understand, let's put it in an illustration. There are 3 business owners. Each business owner owns a different type of business. Miss Elodia, owner of the leading merchandising business in the world, Mr. Jom, the owner of a multinational manufacturing company, and Miss Heidi, an owner of one of the Big 4 auditing firms, which is a service business. These business owners have different types of inventories and have different ways to value their inventory. Merchandising inventories. For merchandise industries such as retailers, wholesalers, and distributors, their inventories are goods that have been acquired and sold in the same form as they were purchased. The value of merchandise inventory includes a range of costs a merchandising business incurs in the course of obtaining the products it intends to sell to its customers. It includes the price paid for the goods, shipping costs, or freight paid by the resellers or retailer, and any other associated expenses, such as transit insurance and packaging, which are directly attributable costs in bringing the inventory to its present location and condition. For example, Alovia's merchandising business purchased her inventory from a manufacturer of computer parts and peripherals. It costs 1 million pesos exclusive of 10,000 pesos freight cost and insurance of goods, while in transit of 50,000 pesos. After it had been delivered to her company's facility, she incurred an additional 5,000 pesos for storage costs and another 50,000 pesos for the promotion and advertising of her products to be sold. Overall, she will value her inventory at an amount of 1,060,000 pesos, which is 1 million purchase price plus 10,000 freight cost plus 50,000 insurance. The storage cost and the selling cost will be expensed outright. Manufacturing inventories. Manufacturing companies have 4 inventories consisting of finished goods, work in process, raw materials, and factory supplies. Let us define these one by one. Finished goods. These are the final product of the production process, which is already available for sale. Work in process inventories. These goods are partially completed and still require further process for it to be readily available for sale. Raw materials. These are the goods that will be used in the manufacturing operations or production process. However, these materials can be traced physically once the end product is already manufactured. Factory or manufacturing supplies have similarities to raw materials. The only difference is that they are indirectly incorporated in the products being manufactured. Let's take Mr. Jom Company as an example, which manufactures high-quality furniture. Consequently, it maintains 4 inventories. The finished goods inventory will include all the finished products just like chairs, tables, beds, etc. since these are all ready for sale. Its work in process inventory will include all partially finished goods and needs more additional process just like chairs that are not yet painted, tables that are assembled but not yet nailed, etc. Its raw materials will be the woods, leathers, fabrics, etc., which can be directly seen in the finished product. It is the opposite of manufacturing supplies like nails, wood glue, protection equipment of the workers, etc., because these cannot be seen once the product is already finished. The cost of the inventory of a manufacturing company includes purchase cost, which comprises the purchase price, import duties, irrevocable taxes, freight, handling, and other costs that are directly attributable to the acquisition. Cost of conversion. Conversion cost includes a systematic allocation of fixed and variable production overhead that is incurred during the transformation of raw material inventory into finished goods. Conversion costs consist of both direct labor and overhead costs. Direct labor is the cost associated with workers who actively produce products, which includes wages and salaries paid to assembly line workers, carpenters, painters, and anyone who helps manufacture products. Overhead costs are expenses used to produce products that can't be attributed directly to a production process. Take utilities for example. Factories must use electricity to power their machines and to produce product. Other costs are included in the cost of inventories only to the extent that it is incurred in bringing the inventories to their present location, such as costs of design for specific customers. According to the framework, the following shall not form part of the cost of inventories: abnormal amounts of wasted materials, labor, or other production costs. Storage costs, unless those costs are necessary in the production process before a further production stage. Administrative overheads that do not contribute to bringing inventories to their present location and condition. And selling costs. Cost of inventories of a service provider. In a service industry, since there is no exchange of physical stock, the inventory can be compared to the costs of services which are intangible in nature. It mostly includes the steps involved before completing a sale. The cost of services, inventories, consists primarily of the labor and other costs of personnel directly engaged in providing the service, including supervisory personnel and attributable overhead. However, labor and other costs relating to sales and general administrative personnel are not included but are recognized as expenses in which they incurred. For example, in Heidi's auditing firm, they have some unbilled work in progress of auditing private companies. These should be valued as the cost of services at the cost of salaries, social security, and pensions. A charge for supervisory staff can also be included, but not a charge for administrative overheads nor sales personnel costs. Inventory valuation method. Choosing the right inventory valuation method is important as it has a direct impact on the business's profit margin. Your choice can lead to drastic differences in the cost of goods sold, net income, and ending inventory. As a business owner, you need to analyze each method and apply the method that reflects the periodic income accurately and suits your specific business situation. Specific identification. The specific identification method relates to inventory valuation, specifically keeping track of each specific item in inventory and assigning costs individually instead of grouping items together. When used for inventory management, it provides more useful information on sales. For example, suppose a car dealership has 20 luxury cars on the lot. Each car has a different dealer cost and a different sales price based on the model and its features. Each of the cars is tracked individually from the time they enter the lot until they are sold. This inventory method will provide more useful information on sales, which model and features of the car are most popular to customers. FIFO, or first in, first out. This method follows the rule first come, first sold, meaning that the goods are sold according to the order they are purchased. For example, You purchased 200 pieces of clothes that cost 300 pesos each in January, which will serve as your beginning inventory. In the next month, you purchased an additional 100 pieces of clothes which now cost 350 pesos each. Let us say that 250 pieces was sold during February. When using the FIFO method, it is assumed that the 200 pieces bought in January will be sold first. Consequently, the breakdown of the 250 pieces sold was the 200 pieces from January, and then the remaining 50 pieces was from the month of February. As a result, the clothes remaining in the inventory are the most recently purchased. Weighted average cost. It is a valuation method businesses use to calculate the average purchase price of each unit of their inventory. The weighted average unit cost is computed by dividing the total cost of goods available for sale by the total number of units available for sale. Such weighted average unit cost is then multiplied by the units on hand to derive the inventory cost. For example, Team's company had a beginning inventory balance of 800 units at a cost of 200 pesos per unit and purchased inventories of 700 and 500 units during the month at a cost of 210 and 220 pesos per unit, respectively. To calculate the total cost, multiply the number of units by the unit cost, and then add these total costs together to get the total cost of goods available for sale. To get the weighted average unit cost, divide the total cost of goods available for sale of 417,000 by the total number of units for sale of 2,000 units, yielding 208.50 pesos. This weighted average cost per unit must be multiplied by the number of units on hand, 700, to obtain the inventory cost of 145,950 pesos. There you have it, all the important things to know about the valuation of inventory. Thanks for watching.